Warren Buffett isn't just one of the world's richest men. He's the most consistent investor of our time. His wealth wasn't built on risky bets or chasing the latest trends. Instead, Buffett follows a simple but disciplined approach that works in good markets, bad markets, and everything in between. The best part? You don't need billions in the bank to use his strategy. You can start today, even with a small amount. So in this video, we're going to cover the 6 most important rules we can learn from Warren Buffett's investment journey. But before we get into those rules, let's first understand his mindset over money. Buffett has said countless times, the most important investment you can make is in yourself. Before he ever bought shares, he built his knowledge. He devoured books, studied businesses, and learned from mentors like Benjamin Graham. His first real stock purchase was at age 11, and even then, he understood the power of patience. Most people try to get rich quick. Buffett plays the long game. By the time he was 30, he'd already turned $100 into over $100,000. Not by luck, but by disciplined investing and avoiding unnecessary risks. That foundation carried him through every market crash that followed. He still spends 80% of his day reading, proving that learning never stops, even for a billionaire. This mindset is a reminder. Money follows knowledge, not the other way around. Rule number 1. Invest in what you understand. Buffett avoids complicated businesses he can't explain. He sticks to companies with clear products, strong brands, and simple business models. If he can't understand how a company makes money, he passes, no matter how popular it is. For example, before he bought Apple shares, Buffett wasn't chasing tech hype. He saw Apple not as a gadget company, but as a consumer brand with an ecosystem that keeps customers loyal for decades. The takeaway? Never invest in something you can't explain in plain language. If you don't understand it, you can't predict its future. Rule number 2, look for the economic moat. An economic moat is a company's ability to protect itself from competitors, like a castle surrounded by a deep river. Coca-Cola's moat is its brand and distribution network. Apple's moat is its ecosystem. Costco's moat is its unbeatable pricing and loyal membership base. Buffett looks for businesses that can keep winning for decades, not just a few years. A strong moat means higher profits, less competition, and long-term stability. For instance, Buffett has held Coca-Cola shares since 1988, turning an initial $1.3 billion investment into over $25 billion, all while collecting billions in dividends. Rule number 3, buy quality at a fair price. Buffett doesn't just buy cheap stocks, he buys great companies when they're reasonably priced. He calls it, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. He waits patiently for opportunities. In 2008, during the financial crisis, Buffett bought shares in Bank of America when they were trading at a fraction of their value, a decision now worth tens of billions. If he had chased overvalued companies instead, those gains might never have happened. Rule number 4, think long-term and reinvest dividends. Buffett rarely sells his investments. He lets them grow for decades, reinvesting dividends so the returns compound. This is why time is the real secret ingredient in his success. If you invested £1,000 in a fund returning 10% a year and reinvested the dividends, it would grow to more than £17,000 in 25 years without adding another penny. Buffett's own Berkshire Hathaway has averaged about 20% annual returns since 1965, meaning $1,000 back then would be worth over $30 million today. That's the power of patience, and most people underestimate it. Rule number 5, stay calm when others panic. Buffett famously says, be fearful when others are greedy and greedy when others are fearful. When the market crashes, most investors sell in fear. Buffett sees it as a sale on great companies. The difference is preparation. He always keeps cash ready for opportunities. During the 2020 market crash, while many panicked, Buffett's portfolio stayed focused on strong businesses, allowing him to recover faster than the market average. Rule number 6, keep costs and taxes low. Buffett invests through tax-efficient accounts and keeps trading costs minimal. For everyday investors, this means using low-cost index funds, ESAs, or pensions. The less you pay in fees and taxes, the more you keep. Over 30 years, saving just 1% in annual fees could mean tens of thousands more in your pocket. For example, if your investment grows at 8% a year, paying 1% less in fees could leave you with over 20% more wealth by retirement. Putting Buffett's strategy into action. If you want to invest like Buffett, 1. Study before you buy. 2. Stick to businesses you understand. 3. Look for companies with a durable advantage. 4. Wait for fair prices and be patient. 5. Reinvest dividends and let compounding work. 6. Stay calm during market swings. You don't have to copy every move Buffett makes. The point is to adopt the principles, patience, discipline, and a focus on quality, and apply them at your scale. So whether you start with 50 pounds a month or 50,000 pounds, the rules don't change. The earlier you begin, the more time compounding has to work in your favor. Warren Buffett didn't get rich overnight. He got rich by never stopping. So next time you think about chasing a quick win, remember, slow, steady, and smart beats fast and flashy every time. Thanks for watching. Start today. Your future self will thank you.